Hi, I'm Tim Sustak, SVP Investments and Treasury with Mid-Atlantic Corporate, and this is the economic update for April 2016. Today, we'll take a look at the most recent employment report and if there's anything in there to make the Fed want to move sooner rather than later. The employment report for March was about as expected. The headline number for job growth indicated 215,000 jobs were added versus the 210,000 that were expected. The unemployment rate moved up a tick to 5%, but that was really due to more people entering the job market, as evidenced by the participation rate rising a tenth of a point, which is a good thing. Average hourly earnings were also positive for the month, coming in up 0.3%. But when you look at year-over-year earnings, the reading's up 2.3%, which is still lagging where we were before the Great Recession, and not enough to create any concern that the economy and inflation are going to really heat up anytime soon. Although headline job growth is nice, it's money in people's pockets that drives spending and moves the economy forward. So while we continue to add jobs and enjoy a low unemployment rate, the issue at the center of debate is how fruitful are the jobs that we're going back to, and how does wage growth get back to a level that will produce increased spending and put more of a spark under inflation. That's part of the issue that our friends at the FOMC are struggling with as they decide when the next rate move will come. A look at that after the break.
Managing your investment portfolio and making sure you follow the strict rules of bond accounting, it's a big job. Unless you use Aton's new bond accounting services. Aton has teamed up with Clearwater Analytics to provide a complete online solution to investment portfolio management. The platform is completely automated and streamlined to make bond accounting easy. It might just be the thing you need to take your portfolio from good to great. Email us today and get started.
Welcome back. So the struggle between dove and hawk is an interesting one at the Fed right now. We got a pretty dovish announcement from the FOMC after their March meeting, and then we saw a number of Federal Reserve Bank presidents come out and speak contrary to that in the following days. Chair Yellen fired back during her comments to the Economic Club of New York, reiterating the need for caution when looking at future rate increases. So where do we really stand? I think that while the Fed would certainly like more cushion in the funds rate should they need it to fight the next economic downturn, that feeling is just not strong enough to counter the one that says there is more danger in rising too fast than too late. This economy is all about the consumer, and as we just discussed, given wage growth and consumer spending, the Fed is not worried about runaway inflation. If they are a little behind the curve raising rates and inflation overshoots their 2% target, the feeling seems to be it will be pretty easy to reel it back in. However, if they rise too fast and inadvertently lock the economic brakes, they could send things into a skid that would be harder to straighten out. Bottom line is June is probably the earliest for the next rate increase, and I think we'll need to see some pretty strong data to get that done. What do the markets think? They're only predicting about a 25% chance for an increase in June and about a 60% chance before the end of the year. That's the economic update for April. Let's take a look at this month's release dates for some of the more important economic statistics. We'll see you again next month for another look at the economy, and as always, thanks for watching Finection.